Whether it's the government shutdown, whether it's tariffs, whether it's geopolitical risk, this ultimately just means loss of faith or credibility in the US dollar.
One thing that's kind of breaking my brain recently
in the German car industry, is this akin to like the Detroit of the 80s?
It's an open secret here that they missed the boat on developing e-engines that people will actually buy.
Car companies are not wrong when they say that they're not meeting their sales right now.
It's the economy, Kassandra.
Hey, and welcome to The Dip, your essential podcast for global money stories. I'm Kassandra.
And I'm Daniel, and later we're going to be talking about the car industry, especially in Germany, and whether US tariffs are having a seriously negative effect on it.
But first, the U.S. government has been shut down for over a week, but the markets don't seem so bothered. In fact, stock prices keep rising, even as the shutdown delays important economic reports that usually steer trading.
Which means that investors are trading in the dark, but that hasn't stopped them, because alongside the all-time highs hit by the S&P 500, gold and Bitcoin are also surging. And you might think, well, logically, if they're rushing to safety by going to gold, then why are they also piling in both on stocks and the even riskier Bitcoin? For more, we turn to Paisley Nardini, head of multi-asset solutions at Simplify Asset Management. Paisley, thanks for joining us all the way from the OC in California.
Now, Paisley, gold prices are up by 50% since the beginning of the year, and it's not just because of all the gold plating in the White House. So what are investors running from?
Yeah, well, thanks for having me, you guys. Super excited. Coming into this year, we actually were talking about this theme. We saw some of these tailwinds coming out of 2024, the rise of gold prices, but it hadn't really hit mainstream yet. And I think the initial tailwind was foreign central bank buying. So if we go back a couple of years to 2022, when the US had put sanctions on, that's when we started to see some of these global central banks starting to buy this hard asset that wasn't really tethered to the dollar. And so that's what I think spurred a lot of this. And now we're starting to see price momentum. And whether we're talking about commodities or stocks or bonds, price momentum is something that absolutely attracts retail investors and retail flows. And we just saw a huge month of flows into gold prices. So I think this has more legs. I think there's more tailwinds that it will spur this, but it is a couple reasons. We're talking about uncertainty. Gold historically has been this safe haven play. So that is a big part of this. Even though stocks, as you mentioned, continue to hit all-time highs, there's a lot of uncertainty out there, whether it's the government shutdown, whether it's tariffs, whether it's geopolitical risk, whether it's rising concentration and valuations. I think people have their foot on the gas pedal, but they're not going as fast as they once were. So gold tends to be that safe haven asset and allows portfolios to diversify. But all of a sudden, it's now become a return-seeking asset too. And so as you're looking at your portfolio and you're thinking about other ways to diversify risks and increase return, for a lot of investors, gold is now playing that role.
So when you talk about these price signals, basically investors have fewer signals to go on because of the government shutdown. They're not getting all of the data that they might usually base some of their decisions on. And so they're looking at the prices rising and saying, well, if I don't get on board, then I could get left behind. And this move into gold is often an inflation protector. Why currently, before we get into the depths of the economy in the US, why are we seeing inflation where it is? Why hasn't it been tamped down further, and therefore as one of the factors that are pushing people into gold?
Yeah, well, I think putting into perspective, and I always like to take a 30,000-foot view. We get so bogged down in the details and we kind of forget where we're at and where we're headed. So if we backtrack a couple of years, in the US at least, inflation hit or peaked at around 9%. The fact that we're already below 3% on an annualized inflation basis, I think is actually quite impressive. And ultimately, as markets and as the government is looking at some of these levels of inflation, we know that we might not go directly to our target, which is around 2% historically. We're going to slowly move closer and closer. And I think we've been in that right trajectory. I do think some of the reasons that inflation has been sticky is thinking about this reset of prices that we saw in 2022. Again, prices have started to come down on a change basis, but that doesn't mean that prices on an absolute basis are going to drop. The other important factor that is kind of still in the back of our mind, I don't know if it's on the front burner still, but is this topic around tariffs. And we have seen prices pick up a bit this year. And that's why I think we're getting some of this stickiness in inflation. And I do wonder if the Fed going forward might start to think about, rather than having this legacy 2% inflation target, which served us in this zero rate environment after the financial crisis, maybe a healthy level of price inflation going forward is closer to 2.5%, maybe even 3%. And so I'm actually optimistic at the level that we are seeing inflation come in today. I think the concern looking forward, because that's how markets think, is forward looking, not backward looking, is whether or not these tariffs will actually kind of feed into the underlying prices that we're seeing in the goods sector here in the US. And that is a catalyst that could spur inflation higher. But again, the US is a service-based economy, and a lot of these services are not tied directly to these tariffs. So I do think there's some wage pressure as well, but to be determined where this leads us. But I'm actually quite constructive on where inflation is coming in the last couple months.
I think it's a very interesting viewpoint, and a lot of listeners will appreciate that take. And one thing that I keep talking about retail investors, institutional investors, but also central banks have been quietly hoovering up gold for months. So is this rally really about investors, or is it more about governments hedging against something bigger?
Yeah, great question. And there's another point I think might be helpful too, as we think about the difference in institutional allocators, central bank investment activity, and retail flows. One of them tends to come before the other. We've actually seen some interesting patterns in the last couple months where, coming out of the tariff tantrum here in the US, we actually saw retail investors driving markets higher, meaning they were first to jump back in before institutional investors. But going back to the question on gold, again, that central bank buying is really what has been the catalyst to lead us to this point. And I think the baton has been handed over in the last maybe couple months from those big central bank buyers, from institutional allocators, to more the retail. And that would help explain some of this kind of parabolic rise in gold prices. That tends to be when everybody's kind of rushing in. And again, gold ETFs here in the US just saw about 35 billion in inflows over the last month or so. This is a historic level of retail flow attracting into this asset class. And then thinking about who are the big buyers from a central bank perspective. Russia is one of the top, China, of course, India as well. And this also then, not to take us on a different trajectory of this topic, but this also kind of explains some of the concern around the level of yields on the back end or the longer end of the US Treasury curve. There's this belief that this central bank shift away from the safe haven US Treasury assets into gold is kind of what's spurring this rotation. There is some validity to that. I think as we look at central bank buying of foreign buying of US Treasuries, we haven't completely seen that bottom fall out. So I don't think people are fleeing the US Treasury market. But this whole idea around what we're calling debasement trade, and that's been something that's been in the news quite a bit. This ultimately just means loss of faith or credibility in the US dollar. All of this is kind of that backbone as to why we're seeing flows into alternatives, why we're seeing flows into gold. I know cryptocurrency and Bitcoin is another topic as well. So this is all happening simultaneously with equities hitting new highs. And again, typically we see risk on assets and risk off assets moving in opposite directions. But really, the last couple of years, there's been a rise in correlations between assets. And so I think this is something that's really important for investors to consider when they are building a diversified portfolio.
I want to talk a little bit about that correlation, Paisley, because, on the one hand, the safe haven traditionally of gold is up, yet on the other hand, markets are on a tear. So if investors were worried enough to seek shelter in the storm, so to speak, wouldn't they be pulling back from markets, or what do you make of this?
A bit of exuberance trade is what I think we're seeing right now. And this goes back to that topic or that term I used earlier, which is momentum. If you're looking at your portfolio and you have concerns, which many USers do, around valuations and concentration risk, this is a very interesting statistic, by the way. If you look at the top 8 stocks in the S&P 500 index, which is just the US large cap barometer, and you look at the top 8 stocks in the NASDAQ 100, which is that AI technology innovative index barometer, those 8 stocks in each of those 2 kind of broad-based indexes here in the US, they're the exact same. And so from a concentration perspective, investors have historically thought that they're getting diversification by getting access to these two different indexes. They're not. They're getting the same exposure in just different levels. So this rise of concentration, concerns around valuation, is really just leading a lot of investors to think, where else can I grab for return? How else can I build a resilient portfolio? And that's why I think gold is starting to rise in the ranks, because then investors are saying, hey, gold is up, 30, 40% this year. So you're telling me I can have my cake and eat it too. I get diversification, a safe haven asset, and I get return. This is amazing. What could go wrong?
I mean, it looks like investors are essentially betting on a rate cut from the Fed, and that's why they feel that they can play both sides. So can you explain why markets are betting that the Fed will go ahead and make this cut? Because it's far from a clean decision at the moment. We know what they might want to do, but inflation is too high according to their markers, but yet we're seeing weakening labor and growth signals.
Yeah, there's two thoughts that I have around this topic. The first is the Fed's reaction. I think they're in a bit of a bind from a political standpoint. And just to be very clear, I think there is independence between the central bank and the US government at this point. I think the Fed is data dependent. The Fed's not going to get away with cutting or hiking rates if the data says otherwise. So I don't have concerns from that standpoint. What I do think, though, is as soon as the Fed starts to articulate their future trajectory of rates, they're kind of beholden to that. It's really hard for them to deviate. And because of this communication and clarity, and again, this is not something the central bank has always done. This is really in the post-GFC era that they wanted to increase transparency and communication, which ultimately then puts them in between a rock and a hard place, because once you've told the markets, this is your plan on cutting rates, if you deviate, markets are going to see volatility and have concerns if you start to move in a different direction. So I do think that because the Fed has articulated expectations to cut probably two more times this year, I think they'll probably stick to that pending any major data information. And that's the issue right now, is where's the data at? In the government shutdown, we're waiting to see the employment data and the inflation data. And until we get that, markets really have to sit back and wonder. And so as it relates to the expectations, then what we're seeing from traders is how can they hedge this, right? Because if we're waiting with bated breath for this data print and all of a sudden it does come out and it's wildly offsides to what the market anticipated, portfolios are going to suffer. So we're seeing a lot of traders and interest rates hedge for either increased rate cuts, meaning that the data from a employment perspective is weaker than expected, and then vice versa. We're also seeing a lot of traders hedge for maybe the Fed to pause. Maybe the data comes in and employment data is strong, inflation data is not concerning. But I do think there's been a shift in the last couple months away from the focus on inflation, which was really where the Fed was focused all of 2023 and 2024. And they've started to refocus on the employment data. And that's where we are starting to see some cracks in the labor market. And so I'm hoping the government shutdown will end soon. And so we can get some of this data. But I do think that could be a big catalyst for volatility in the back half of October and early November.
Now, of course, you've said it, I've said it, the U.S. government is shut down and important economic reports have been delayed. But I'm wondering, at what point is this going to cause traders or investors to freak out a little bit? Like, where's the deadline? 1 week hasn't been enough. 2 weeks, 3 weeks? What are you anticipating?
Yeah, that's a good question. I would say, too, even when we were getting our frequent, regular expected data prints from the government, I think a lot of holes have been poked in those in the last couple months, whether it's politically motivated or driven or just realizing how volatile some of these measures are. I think a lot of people have started to say, is this data relevant any longer in the way that we're capturing it or collecting it? Is this data actually telling us the truth? And so I think a lot of investors have started to look beyond even some of the data prints into other ways to assess the state of economic growth, the state of the markets, looking at measures like credit spreads, looking at measures like corporate profits, which have been very resilient. That's one of the kind of key data prints that I think is sending conflicting signals, right? If there are cracks in the labor market and the economy's state of being is starting to decelerate and growth is decelerating, how are these companies delivering such strong profits? Looking at commodity prices, this brings us back to gold. So a lot of really conflicting signals, which, not to have a cop-out answer here, but when it's murky ahead, maybe we just diversify our portfolios, because as Howard Marks said, the only free lunch in markets is diversification.
Though there still is a lot of concentration in the top tech firms and in AI, and we've seen that just accelerate further and further. And just to bring in the political aspect, are investors simply betting that Washington will sort it all out? Or would you say that they're going so far as just ignoring the risks altogether?
I think everybody's optimistic based on historical instances where the government has shut down, the duration of which I think could have an impact on markets, but this typically gets sorted out in short order. Not to say it will this time, but historically, when the government has shut down, markets shrug it off. Ultimately, the theme of loss of credibility or faith in our US government, I think, is the biggest risk right now, because that theme was already taking place earlier this year. And so right now, this is just another nail in the coffin for investors to point to and say, look, the US government does not have their act together. They can't figure it out. And I think that just further spurs some of these trades away from US assets into international assets. But ultimately, I do think that they'll figure it out. Markets have shrugged it off thus far. And so the biggest risk, in my opinion, is that it's going to come time for the Fed to have to make a decision later this month on cutting rates or pausing. And if they don't have the data to do so, I think the best course of action would be to pause. And if they don't, and they continue to cut rates without the data, that's when I think investors start to get concerned. Is the Fed politically motivated, or are they actually data dependent? Because if you don't have the data, it's hard to prove that you are data dependent.
One thing that's kind of breaking my brain recently is this idea that gold and Bitcoin are both surging at the same time, because crypto tends to follow hype cycles and gold follows fear. So what explains this kind of split personality that we're seeing in the market right now?
I feel like most assets are moving higher. I feel like people have become indiscriminate when it comes to investing, and let's just grab it all. The benefit of that is a little bit of broadening out of kind of the leaders of the pack, which does encourage me, because that means ultimately, if you have $1, you can either put it all towards equities or you can divvy it up across other parts of the portfolio. So does the rise of some of these, differentiated assets, whether it be crypto, whether it be commodities, alternatives, that's going to pull some of the money away from equities. And so maybe it is a more balanced approach. I do think Bitcoin is kind of running in its own track, in the sense that it's a very volatile asset. I think we need to remember that, although this year to date, I think it's up about maybe 30 to 40%, which on an absolute basis sounds really encouraging for an investor. But if we put that into perspective, Bitcoin tends to have these cycles, not to get too in the weeds, but it's known as kind of this halving cycle, where every 4 years, the amount of Bitcoin that's mined, that's put out from an emission perspective, is reduced in half. And this is to increase the scarcity, knowing that it's a finite asset. And so as a result of this, and I don't know how much of a technical trader I am, but if you look at kind of the price patterns or price charts of Bitcoin over time, you have this really nice pattern of every 4 years, Bitcoin kind of has this rally and then it pauses. It has a rally and then it pauses again. And we're in the midst of one of these periods where historically Bitcoin should be and is in a rally. And so the last 2 calendar years, we've had really strong returns. This year is moving in the right direction. But relative to the last 2 years, Bitcoin's been a pretty mild asset to its own history. So I do think there's a lot more legs behind that. And I think this kind of rotation trade into more alternatives and diversifiers is going to be a catalyst. I think important, though, the other catalyst is the narrative. We've seen very large investment managers here in the US launch Bitcoin strategies and ETF vehicles, for instance, and then they put them in their model portfolios. And then they explain to investors why it's such a vital part of a resilient portfolio. And so this self-fulfilling narrative drives the flows as well. I know one of the largest investment managers in the world recently launched a Bitcoin ETF, and it's the most successful ETF in history from an asset gathering perspective in a short period of time. And so again, this narrative and support, I think, leads flows, which is kind of the broader theme in that momentum trade again.
Well, Paisley, from my side, I couldn't let you go. Kassandra might have another question, but I couldn't let you go without finding out what your case is, your base case for where the dollar's going to head at the moment, because the weakening has got a lot of investors kind of anxious about where they should rush to at the moment. So where do you see it going?
I think there will be continued pressure on the US dollar for a couple reasons that we've already discussed. One is this idea around the debasement trade. And again, that term just meaning a loss of credibility or faith in the US dollar tied to the loss of faith in the US government. I don't think that theme or that narrative has exhausted itself yet. And this government shutdown is just another catalyst to keep that theme front of mind for many investors. So I do think that we've seen the dollar plateau in the last couple months, meaning its trajectory lower has kind of stalled out. I do think that there will be additional catalysts for why that will continue to move lower. But at the end of the day, when we think about global currencies, I think the US government is fairly resilient. I think that US assets and the US dollar in particular continue to be a go-to for many global investors. And so even some of the short-term weakness, again, that 30,000-foot view and putting this into perspective, I still think the US remains at the forefront of being a global leader, especially in the investment markets.
Paisley Nardini, Simplify Asset Management. Thanks so much for joining us on The Dip and really clarifying all of this.
Germany's car brands are in crisis at the moment. All the big names that you know already, Volkswagen, BMW, Mercedes, are struggling to keep up. And that made the summit, which happened yesterday, all the more important. Big manufacturers and suppliers meeting with the Chancellor of Germany and asking him for help.
Joining us now are Stephen Beardsley from our business department and Michaela Küfner from our sister podcast, Berlin Briefing.
That's right. Thank you very much for joining us both. Steve, can you kind of just sketch out where things are at the moment? So in the German car industry, is this akin to like the Detroit of the 80s, except rather than Japanese competition, it's Chinese competition, or is it more complicated than that?
Well, I think, first of all, Daniel, if you look at where things are right now, I mean, it's massively problematic, right? Profits are falling. We know that there's a lot of job losses, 50,000 in the past year alone, according to one recent calculation, and likely more to come. And we know that in the first half of this year, many automakers have produced pretty poor numbers so far. If you look at Volkswagen, for example, even though sales were up, profit margins far down, far below what they would want them to be. And even after they released those numbers, they released even more news that profit margins are going to fall for all of 2020-25, closer to 2%. That means on every sale, they make 2% profit, in other words, for a company that is targeting much, much higher than that and was hoping for maybe somewhere around between 6 and 7% long term, not that long ago. But that's the situation that they're in. Is it like Detroit? To some extent, there are parallels. You could say that there's a kind of self-satisfaction at play. People would accuse German car makers of being self-satisfied with where they were for so long, with thinking that they understood the markets and that they didn't have to innovate because that they own the markets. And then, of course, as you mentioned, Japanese in the 80s came and really put a scare and started offering cars, in the case of Detroit, smaller cars that people actually wanted, that they weren't finding from American automakers. You could say the Chinese are now in that place, perhaps. On the other hand, it's not so simple. We're talking about a completely different drivetrain that automakers have suddenly had to switch to. And there are regulations behind this that really have teeth. There's a regulatory framework in the EU. And so it's not so simple just to say that, this is something that they just sort of happened into. You could see that in certain markets, but on a whole, it's a bit more complicated than that.
Michaela, let's get the political overview from you. How big of an issue is this in Germany?
It's a huge issue because the auto industry and its suppliers is the key industry here in Germany with the largest workforce in the country. And I literally just came back from what's called the auto summit at the German Chancellor with representatives from the coalition government, also from automakers, but also from the trade unions, having sat around the table and trying to work out how they can bolster the German industry as it is and pave its way into the future. And there we once again heard that 70% of those crucial jobs that make or break elections here in Germany are in the export industry on the auto side. And here Germany is really struggling, not just at home where those cheap Chinese electro cars are really driving the competition home quite literally, but also and in particular when it comes to those exports. And just to illustrate, it's interesting that Porsche, for instance, is now reverting its policy to go all e-vehicle and now is continuing to develop combustion engines again. And this, some experts are saying, is proving very costly because they simply can't decide whether to preserve what they've got or make a cut and try and make a leap into the future.
Okay, but Michaela, we'll get into the deeper diagnosis in a second of the situation, but just at kind of as the first step, why has the government struggled to fix this? Why haven't they been able to come up with a policy solution at that level?
Well, first of all, it's interesting that it seems to be the sense from automakers who've made huge profits in China over the last couple of years, which are now being driven down. The money was made in China. It wasn't made in Germany for a long time. And these auto summits always give everybody a sense that it is the government's job to fix the car industry, whereas it's an open secret here that they missed the boat on developing e-engines that are also very much consumer orientated, that people will actually buy, because the problem is the demand isn't simply there. And the automakers say, look, government, you need to build that infrastructure and it's not here, and that's why there's no demand. And so it's a bit of a blame game to a certain degree, but we're now seeing a will to have a compromise to actually drive a harder bargain in Brussels again, to shift away from a target of 2035 when those last CO2 emitting engines were supposed to be phased out. That looks like Germany will take a different position there. And that will be on the preservation side of the combustion engine, those old profit makers, because there are still consumers out there who want those high-end German cars, combustion style. But then there's also a political commitment to be driving the future. And there are some question marks whether this auto industry can actually do both, and whether that won't cost those jobs anyway and just prove to be really costly in the end.
Steve, car makers and suppliers want more support from the government, right? But businesses are always asking for tax cuts, subsidies, slashing of regulations, and so on. Is there something different, though, from your vantage point about it this time around?
I think it's the sense of urgency. I think Michaela touched on this. It's often been said around 800,000 people, I believe, directly employed by the auto industry, and that includes the suppliers. We often don't talk about suppliers. There are major suppliers, component builders here in Germany that feed into supply chains throughout the world. So it's not just the BMWs, the Volkswagens, the Mercedes, but also these massive other companies, this whole network and infrastructure. It's that urgency, and it's the fact that they know right now that they're not alone. The auto industry isn't the only industry that's struggling right now. And since the war in Ukraine began, energy prices shot up. Competition from China has increased. It's also other branches, such as the machinery industry here in Germany, one of its strong points over decades, that's also struggling under the same conditions. And so it is just one of several sectors now calling for what they would call a change in business environment. And that means bringing down energy costs. That means bringing down bureaucracy and potentially bringing down the cost of labor, which is maybe a much more difficult adjustment to make. But all of these things, they say, are basically creating a prohibitive field for production within Germany. Now, of course, production in the car industry goes beyond Germany. They're selling around the world, and they have locations around the world. So how do they stay competitive? And that 2035 deadline really is about that. And so that's the regulatory framework within which they exist. And they're not alone in terms of the EU, most likely not alone. Michaela might know more about this. But there are other Alto nations that are heavily reliant on the industry. Spain, for example, comes to mind, France as well. And so all of them are struggling right now because of the conditions in the sector.
But Michaela, the US tariffs are a factor here. They're not. I wouldn't say they're the major factor dragging Germany back. There's something much more fundamental there. But they're a headache that the industry doesn't need right now. So how is Germany handling Donald Trump's tariffs?
Talk to any industry, nobody needs tariffs. Yes, German cars being imported into the US are now 15% more expensive. That's the tariff that is being charged. There are European Union counter tariffs, but it was put into perspective at that summit. The jobs depend on those auto exports. The domestic market simply is not going to compensate, and the domestic market also being the European Union market. I was at an event last year where Emmanuel Macron, the French president, was on the record saying that basically the European car industry was not going to be the industry of the future, which was a bit surprising back then. But, it is an industry that represents the status quo of an industrial Europe, and particularly an industrial Germany. And there seems to be real resistance to think in terms of, okay, which other jobs could be created to compensate for this, and because that means taking a political risk, and nobody is willing to take that particular risk. Also, in the broader sense, in the broader picture, the feeling of this current government is that their worst enemy is the public mood here in Germany, that there is not a drive to let's embrace innovation, let's embrace change. And that is also something the government let's put it this way, is not willing to work against and then face a backlash. And clearly it's not fast enough in offering a path out of what has been Germany's poster industry for almost a century now.
Now, you just mentioned counter tariffs, but those are decided at the EU level. So what power does Germany have here? Can Chancellor Merz at least make sure he has Trump's ear to put the automaker case to him directly?
Well, he always does protest too much that he does this, but they do speak. And there's always a point made by the Chancellor of Europe's largest economy, the world's third largest economy, Germany, and not to steal the thunder, the limelight from the head of the European Commission, Ursula von der Leyen, who also happens to be German. So she's very much well aware of the issue. He certainly has the ear of the US president. He has the ear of the European Commission president, and Germany's voice is always going to be heard. But it raises a lot of questions about what does this do to those future industries, to the manufacturing for batteries, for cars? Are these industries now not going to grow fast enough? Are you going to be stuck somewhere in between? And at the same time, you have China in particular racing on. And I also want to add that the biggest US exporter of cars is BMW. It's a German company. So the success of the German auto industry is also something that has been exported. What we're focusing on here is the jobs that remain in Germany, and particularly also the social fabric this would cut into if those job losses continue. And Stephen already mentioned 50,000 alone this year, and there are predictions of up to 90,000 over the next 5 years, but those predictions could be revised and even become worse.
Staying briefly with this EU level of questioning, Michaela, are the German government's hands tied by EU emissions or industrial policy, and where is the friction between these two?
Well, the German government was actually has agreed to a target of phasing out CO2 emitting engines in effect the combustion engine, because there's no combustion engine that can run on a fuel that doesn't emit anything at this stage, but that would be quite a technological leap by 2035. And having listened very closely to the Social Democrat Vice Chancellor who was on a podium today, together with the German Chancellor Friedrich Merz, it looks like Germany is going to push for that to change, and pretty fast. We expect an EU summit at the end of October, and we will see Germany push the envelope there, although we failed today as collective journalists to extract any clear signal out of the German government on what that will mean in concrete terms, but it has to mean that 2035 deadline, that will potentially fall here in the European Union.
Okay, and Steve, I want to talk to you about that 2035 deadline, because we keep coming back to it again and again. It seems to be a cornerstone of the issues that the German car industry has here, that the regulations are too tight, that they're forcing them into a corner, meant to encourage them to innovate and make their cars a lot less, to reduce the emissions of their cars. But how would you describe how they are seeing this versus how the EU is seeing this cutoff date for sales of combustion engines?
So remember, Daniel, 2035 is a target for all new car sales to be essentially zero emissions. And that doesn't mean net zero emissions, but it means zero emissions, nothing coming out of the tailpipe. And so that's basically in favor of electric vehicles. And it was decided at a time when there was a lot more climate fervor, I would say, within the EU, and in which automakers saw that China was really moving in that direction as well, that there was excitement about the technology, that Tesla was doing well. And it was after Volkswagen's diesel scandal, for example, in which many car makers were hoping to sort of turn the page anyways, you could say. And so 2035 was, I'm not going to say fully embraced, but it was more or less embraced in line with climate targets. And the idea was, again, that there would be nothing coming out of the tailpipe at 2035. And that's not just one goal that everyone's looking forward to. It already has teeth right now. And that's exactly the problem, is that the car makers aren't on a path to stick to 2035. They're not going to meet it on the path that they're currently on, but the teeth are still there, and they're sinking in every year. Now, it was already loosened somewhat this year. In May, they decided that they would actually take, instead of, and let me just clarify, basically every year, car companies are measured on how much carbon by gram, how many grams of carbon they are emitting per kilometer throughout their whole fleet. And that's averaged together. And then if that exceeds the EU standards that sort of set out that path to 2035, then they have to pay a penalty for that. And so 2025 was a year in which that target was going to fall again. And that meant that a lot of car makers were set up to surpass that and owe a lot of money. And so they began complaining late last year. They continued early this year and said, this is something we can't really afford right now. The EU listened, and they softened that target, and they said, look, we're going to let you take the averages from 3 years and put them together. That means if you miss it in 2025, you can make it up in 26, 27. And so I think that's sort of what they would like to see more of, is more of a move in that direction, an acknowledgement of the current realities. If you talk to executives at these car companies, and I had the chance in Munich recently, there's a big car show, the IAA, they will tell you publicly, they say, look, we have committed so much investment towards electrification. We're all in. Obviously, decarbonization is important, but we need a little bit of laxity, right? We need a little bit of wiggle room. And you can understand it, because they say they're not going to meet their targets. The question is, again, what does that look like? And if it is just softening some of the regulations, extending the date out besides 2035, that's one thing. But another possibility, and the one that, as I understand it, the German government is really talking about, is saying that the combustion engine itself does not have to go, that there is the possibility for another kind of technology that many proponents of this talk about, that is a kind of e-fuel or biofuel, in which you would still have emissions coming out of the tailpipe, as far as I understand it, but it's already something you've captured early on. So it has a net zero effect. This is not what the 2035 agreement was about. It was about a net zero. It was about a zero tailpipe emissions. And that would be a big change. And someone may look at this and say, okay, but the ultimate effect is net zero. It's decarbonization. But the critics of any sort of softening and allowance of the combustion engine to stay is that they say the car companies will just keep building combustion engines, and this technology may not come along because right now it's not mature, it's not market ready, and there are still those who have a lot of doubts that it will be that it will be everything it's amounted to be. and that instead the car companies are really just pushing for a way to hold on to combustion engines to make up for sales that they're not seeing in battery electric vehicles. So I think it's worth keeping all these things in mind. The car companies are not wrong when they say that they're not meeting their sales right now, that things are going more slowly than they projected during those early years. And the question is, what's going to happen? What is the reapproach? The EU has shown that it's open to ideas and that it wants those by the end of this year, and then we're going to see what happens.
And Steve, like any car maker, what they would dream of having if they could is to just choose one form of propulsion and to be able to stick to it. That would be the most efficient way to organize their logistics and their suppliers and so on. But at the moment, they're having to do the splits, essentially. They're having to appeal to the Chinese market with EVs, of course. They tend to be a younger profile of buyer. They are focused on, for example, the software experience. But in the US and in Europe in particular, they're interested in a different kind of category. Maybe they are the older, more traditional buyer. They don't really have that much interest in electric necessarily. So how are they supposed to square this circle? Because they can't be all in on both.
Yeah, if I knew that, I wouldn't be here talking to you. I would be consulting the auto companies. There is no easy reality to this, and that's the problem, right? Is that they know this as well. Car markets are diverging. And while some people may say, there are those who say, look, there should have never been a requirement from the EU to build only electric, right? It should just be combustion engines or whatever they want to do. The fact of the matter is that there would still be a split because you have this reluctance in several markets to take up these EV cars, and then you have a pedal to the metal really in China. You're exactly right. And let's understand that China is the most important sales market for German automakers. Single sales market, I should say, within the EU. If you look at Volkswagen, for example, within the EU, I believe it's 44% of their sales come from the EU. And then something like 30% of their sales come from China for Volkswagen. Now, that's one of the extremes. They've really put a huge market share into China traditionally, historically. But that goes for a lot of other German automakers as well. They really lean on China. And that means that regardless of what the EU had decided, they would have to satisfy that market demand. But at the same time, because there's such low uptake here, then it's difficult to use what you've used for one market for the other. And so that means they're splitting. And so what you see, Volkswagen is still a good example. They talk about we build in China for China. And they've taken on several strategic partnerships with carmaker Xpeng, for example, with whom they're developing several cars for the Chinese market. With Thundersoft, that's a software supplier that's really focused on the Chinese market. Because as we often hear, maybe it's become cliche, but Chinese drivers, they sit in traffic, they're younger, and they want cool doodads, right? This is sort of the kind of, what every car maker says. And we've always talked about karaoke in the cars. There's also selfies and all these kind of apps that are sort of fun. And whether, the extent to which this is true, it's hard to say. There is obviously truth to it. But the fact of the matter is they are two different markets. And so the decision right now is to really try and as much as possible juggle different strategies in different markets. Back here in Europe, when we were in Munich looking at some of the newest models that they're bringing to the European market, what they're actually doing there is they're making electric vehicles look less like electric vehicles as they rolled them out before, Volkswagen, a lot of other, Mercedes as well, and they're combining them with the designs for traditional combustion engine cars. And that's because they know that the mainstream buyer here is still uncomfortable with something that looks so new and novel. Those who are really wanted to jump on the new technology and bought Teslas, those guys have already had their cars. How do you appeal to that volume buyer, that mainstream buyer who says, well, I could buy this Polo or I could buy this Polo, but if one looks sort of wonky or weird, maybe they're not going to buy it. Thomas Schaefer, the brand CEO for Volkswagen, he told me, look, we don't want door handles that you sort of pop out when you press a button. That sort of deters people. We want more push buttons in the car. Mercedes, for example, combining their EV design with combustion engine design, they were famously criticized for their EV models looking like jelly beans, having this kind of rounded design architecture. Volkswagen also had a lot of kind of design architecture that said new, different, novel. And now you see that going back. They're trying to reassure that volume buyer, whereas in China, they're really trying to say, hey, we've got that novelty for you.
Steve, I'm a little hurt that if you suddenly got a crystal ball, you wouldn't stay with us here at DW, but I understand completely. But what you've been outlining here, it's kind of got my brain a bit muddled because German car makers, on the one hand, do see budget EVs as a cornerstone of their future proofing. But like you said, making cheap cars, it's a volume play. You need to sell a lot of them. So is there enough demand to soak that up in Europe and the US?
I would say we often hear talk about affordable EVs, but I would take that in relation to non-EV models, right? There need to be comparable EV analogs to what we're seeing in the combustion engine models. And so far, there haven't really been that. The batteries are expensive, and it's just been unclear where the technology is moving. The battery ranges haven't been that good as well. So you're looking at a more expensive car. You don't know if you're going to find also the charging infrastructure here, and you don't know really how it's going to age and how it's going to resell. And so I think what's necessary is that they can produce on a volume level, again, especially talking about Volkswagen, which is a volume mainstream car seller, to be able to bring that scale to bear and be able to kind of standardize EV architecture across their many different brands so that they can produce cheaper versions of cars that they would say now that everyone more or less knows, right? So you don't just have to buy a Polo, combustion engine. You can buy the EV, and you're happy with how it looks. You understand it, and it's affordable, and you know that actually it will be a reliable car in the future. And I think that's the real challenge for them is fundamentally that affordability prospect, and that people know that they can rely on it. Again, it comes down to reach as well, battery cost, and what's this thing going to resell at? And right now, they're not quite there. I think it's going to be interesting in 2026 because Volkswagen has among its three sort of core brands. If you look at Skoda, if you look at Cupra, which is part of Seat, a Spanish brand, and then if you look at the Volkswagen brand itself, they are sharing the infrastructure for a basic kind of family urban car models. They have 4 models on one platform, and these are going to be sort of their volume play for EV at the 25,000 euro level. And they really hope that they're really going to start bringing their economies of scale to bear. Because remember, when Tesla came out and they started to mass produce their cars at a level that we hadn't seen before, and everyone said, okay, this is not just a startup, but a real car company, then it was often said around here, but Volkswagen knows how to bring it to scale.
Right.
They are a volume producer, and once they crack this thing, they're going to do it. But they haven't been able to, and that's been a real kind of black eye for this company over the past few years. And they've had to change
Right.
CEOs because of it. Software has been a problem, as many of our viewers may know, but it goes beyond that as well. And so they're really finally looking for that time where they can bring that kind of scale that they have over multiple companies to bear. But software is going to continue to be an issue, and there may be some other things as well.
So, Michaela, let's bring it back to the political level. We've heard lots of promises from Chancellor Merz on industry and the economy. He's clearly recognized that there's plenty of work that Germany needs to do to revive its economic growth. What has the response been to his plans and his execution so far from business leaders and also the general public?
Well, so far, the response has been it's not enough. In fact, the IFO Institute here, which measures the satisfaction of all industries, but in particular the car industry, sees the mood, particularly amongst automakers and their suppliers, dip further and further. It's now at the minus 20-something range. And what we get here in Germany is because the car industry is so central. There's a saying that if the car industry has a snuffle or a slight cough like me today, I'm sorry, I apologize for that, then the German economy already has the flu. And this usually sparks a political lashback that can lose you elections. And from what I've heard at this auto summit, we potentially have more regulation coming up here, and we might even see more tariffs coming up, because there will now be a scheme, but we don't know the details of this yet, to encourage low-income earners to buy electronic vehicles. And then we heard the government stress, but we want those vehicles, of course, to be European ones. So there will be one measure or another to prevent this going to those Chinese automakers who already face European tariffs. Then also we heard directly from the German Chancellor that there must not be a hard cut, he said, in 2035, that magic deadline that is expected, or was always expected, to see the end of the combustion engine here in Europe. So we expect that to be softened. And we've seen the government just drop the insurance for cars, the car insurance. No, sorry, not the insurance. We've seen the government drop the car tax for electronic vehicles until 2035 as well, pushing that forward, extending that. So these are all benefits to kind of get more of an appetite towards the domestic car industry going again here in Germany? Is the German government getting out the big Band-Aid for its key industry? And I'm reporting now on the third consecutive chance that this is a German reflex. But now it's taking place in a very different setting. We have a technological revolution going on. We have a digital revolution going on. We know that shifting to electronic vehicles was always going to cost jobs. And we know that those supplying industries are no longer the industries that are needed to produce these cars. So that is something that is not being openly addressed. And there are political attempts to duck this issue, but something's got to give. They won't be able to duck away from this. It's going to potentially become very costly here in Germany. And that is the open question here, how they will manage to sell this to the German voters.
Another open question is related to the populism that we've seen on the rise here in Germany. Do you think job losses could fuel more populism, more of a rise of populism? And what does that mean for some of the tough economic decisions that, well, just, aren't popular?
Well, I was almost tempted to quote the old sentence by Clinton, "It's the economy, Kassandra." But that doesn't really quite translate here in Germany. It's the stability here in Germany. Stability is the political promise that will gain you votes. And here you have a far-right Alternative for Germany party that keeps more than alluding to the good old days. Were they really that good? I'm not so sure. But people have this kind of nostalgia to certainty where the world was less complicated. And in the face of those significant job losses, that could be seen as an alternative that people might then want to vote for, that promise for the good old days. And Friedrich Merz is visibly, with his Social Democrat coalition partner, torn between making a cut and going the full way in terms of innovation and reform and preserving what is needed to keep the social fabric intact, to keep this economy, but also, more importantly, this whole society together in the face of what is essentially a hybrid war by Russia, where we are sure to see any kind of political story, but also economic story that sows division, and job cuts is one of those, get more and more range, get more and more of an echo of a voice in German society. So it's a very delicate balance this government is trying to strike. And it shows how running an economy is not, for sure, simply fact-driven. It is driven by humans, and it is driven by emotions and by fears. And that makes it less scientific than many of us often believe the economy is.
And I think that's building up to the big question that we keep circling around, which is, if I go to you, Steve, industrial production fell sharply in August, 18.5% collapse in vehicle production. At the same time, new orders in manufacturing have dropped for the fourth straight month. So are we seeing a deindustrialization of Germany? And does the country have a plan B, another industry which it can go to as its growth generator?
I think deindustrialization is definitely a charged word in political terms, in political circles. There is a deindustrialization of advanced Western economies in general, right? The fact is that Germany has just deindustrialized slower than other nations, but it is on a similar path. And most economists think that's almost a rule of economics, that as societies become wealthier, then they export many of their cheaper production elsewhere so that they can then pursue more advanced manufacturing or service jobs. Service sector obviously starts to blossom once incomes rise. And Germany's no different. It's just that Germany was on a different path. If you think about globalization and especially China's role in globalization, it's often said that Germany, if China was the workbench of the world, then Germany built that workbench, right? I talked about the machinery industry here in Germany. That was a key partner with China. China was its key customer in outfitting those factories that then produced for the rest of the world. It's just that over time, China it invested more in those areas itself, and it became capable to do it itself. And so now it's competing with Germany in many of those areas. So, including cars. Cars is obviously the example that we're talking about here. So, when you talk to economists about this, and the ones who I tend to find most plausible, they say, look, this is a process. Germany's just at a different level of it right now. And the question is, as you said, will anything replace that? Can anything replace the global introduction of China into world trade? It's hard to imagine that there's any one industry, there's any one sector that's really going to benefit from that. We're going to see sectors fall a little bit. We're going to see them sort of contract, and that's what we're seeing right now. And future technologies, when we talk about the future technologies that are supposed to really sort of have dominance in the world. When we talk about AI, when we talk about quantum computing, perhaps when we talk about robotics, Germany does well in these areas. They do really well in the technology in these areas. You can go to a place like Munich and find an intense number of startups and technicians and engineers who are building what will become future technologies for all of these areas. But they're not good at leveraging that into jobs here. Now, would they ever be leveraged into the amount of jobs that the auto industry can provide? Probably not. But those future technologies are being developed here in Germany. Germany has an incredible education system, an incredible engineering background that can still bring to bear across the world. What it doesn't have is the ability to leverage that into large companies. Much of the funding for many of these companies that are startups at first in these future tech areas, the later stage funding is going to come from the US and maybe even from China later. That's just the fact. That's an intense amount of money that Germany can't bring to bear, and that Europe so far has been unable to really leverage across 27 different economies, despite its intent to do that for so long. So, Daniel, this long way of saying is that there's no key economy that's going to come and replace the auto sector. That's just not the way it is. Times are changing. And again, that's a crystal ball that I don't have. There is a lot of reason to hope that Germany will play a future role in many of these coming technologies. It already is. But can it really create jobs around it? Germany has also traditionally played a major role in the chemistry industries. In glass and things like optics. Zeiss, for example, a famous, very old family-owned operation here in Germany. It goes back a long time. Now they're making materials that help print the lithography on semiconductors. That's a huge business right now. It's incredibly important, and Zeiss is right there for it. But will it create the jobs that really this country needs for, as Michaela said, stability? That is the question. We don't see that. We don't see something replacing the auto industry as just falling into our laps and doing that.
Michaela, just before we go, maybe you can tell us a little bit about Berlin Briefing and where our listeners can find it.
Yes, well, Berlin Briefing is your podcast if you want to hear what is being talked about in the corridors of the German Chancellery, the Foreign Ministry, the Defense Ministry. We talk to politicians so you know the next move that Germany is going to make and what impact Germany and German foreign policy has on you, wherever you live. And you find us either on YouTube or wherever you get your podcasts.
You talk to the German politicians, so we don't have to. Thank you very much, Michaela, for that. Michaela Küfner and Stephen Beardsley, thank you so much for that lowdown.
It's always so fun to chat with our friends at Berlin Briefing. Check out their podcast too, which you can find in the show notes if you're listening to the audio-only version. And if you're watching on YouTube, check in the description to get that link. And while you're watching on YouTube, you can also leave us a question for our Q&A. And if you're not listening on YouTube, then you can email us. What's the address? I've forgotten it. thedip@dw.com. Yeah, because we want to get the information that you want to you in the best way possible, which is you ask us and then we ask them. We do our best. It's a game of telephone. But that's it for now. Until next time, this has been The Dip.
Bye.